Imagine you are running this massive multinational corporation. You've got offices in London, New York, Tokyo.
Uh,
But by law, your biggest overseas manufacturing hub is forced to live exactly 1 year in the financial past.
right.
Like, if the global financial authorities update a rule on how to count revenue today, your factory legally cannot use that rule until 12 months from now. So today, we are plunging straight into the financial engine room of Thailand to figure out, why that happens. We are decoding the Thai financial reporting standards, or as it's commonly known, TFRS.
Yeah, and the documents you've shared with us outline a system that is just incredibly revealing. I mean, whether you are analyzing international business structures or maybe prepping for a corporate strategy meeting, or even if you're just fascinated by how different countries handle the universal language of money.
Which is a language of its own, really.
Exactly. The mechanics of Thai accounting offer this masterclass in balancing global integration with, well, local economic reality.
And we have a very specific mission for this deep dive. We need to break down the relationship between those global standards and these local Thai rules. We need to uncover the massive divide in Thailand between PAEs, the publicly accountable entities, and NPAEs, the non-publicly accountable entities.
Which is a crucial distinction.
Huge distinction. And we are going to extract the tangible aha moments that show how the actual rules of math change depending on, well, who is looking at the books.
Right. But before we get into those two different tiers of accounting, we really have to look at the global blueprint, because Thailand doesn't just invent its financial rules in a vacuum.
Right, they aren't just making it up as they go.
No, not at all. The foundation for TFRS is the International Financial Reporting Standards, or IFRS. The overarching goal of the Thai financial authorities is to ensure their local reporting remains totally consistent with global practices. So for the most complex businesses, the Thai standards are modeled to be essentially a one-to-one reflection of the international rules.
And that brings us right back to the time travel problem I mentioned at the start. So if the International Board issues a new rule, Thailand adopts it. But the documentation highlights a fascinating legal hurdle, which is that all financial statements, accounts, and related documents in Thailand must be recorded in the Thai language.
Yes.
If you have foreign language documents, they legally must be accompanied by a Thai translation.
And that requirement, it changes everything about the implementation timeline, because accounting is a field of absolute unyielding precision. You cannot just run a new, 400-page international financial standard through automated translation software and call it a day.
Right, it's not like translating a restaurant menu.
Exactly. The terminology must be exact to hold up in a court of law. In the sources, we see these really extensive notes on translation localization. The committees will spend months debating whether to use a phonetic borrowing for a term like supplier, or maybe a traditional Thai term for seller.
Wow.
Yeah, they have to make sure abbreviations for debit and credit are perfectly localized.
I was trying to visualize the stakes here, and it's a bit like a massive software update for a global banking network. Like, if the developers release an update in English, and the localization team makes even one slight error translating the code into another language, the entire system could crash.
That's a great analogy.
But in this case, a bad translation doesn't just crash an app. It leads to corporate fines or massive tax liabilities or, executives going to jail for misreporting revenue.
The legal stakes are just immense. And because of that rigorous translation process and the required local due process, the effective date for new TFRS rules is typically delayed by a full year compared to the global IFRS effective date.
So there's the 1-year lag.
Right. The global standard goes live. The Thai authorities spend a year translating and debating the legal phrasing, and only then does it become the law of the land locally.
And it isn't just a strict copy-paste translation job either. The sources mention that while TFRS is a direct translation of the international rules, it also includes additional local guidance tailored for specific Thai business practices.
Yes, it does.
For example, they highlight, and I'm quoting here, business combinations under common control. Now, I have to pause you there, because business combinations under common control sounds like absolute corporate word salad.
It really does.
Break that down for me. What does that actually look like in the real world?
Okay, so imagine you own a successful logistics company in Bangkok, and your brother owns a massive warehousing business.
Okay, I'm following.
Both of those companies are ultimately controlled by your family's holding company. Now, if you decide to merge those two businesses together, that is a business combination under common control.
Oh, I see.
And in the Thai economy, these large family-controlled conglomerates and complex cross-holdings are incredibly common.
Yeah.
But the global IFRS rules might not offer enough specific, granular guidance on how to account for, siblings trading companies under a parent umbrella.
So the local authorities basically take the global blueprint, translate it into Thai, and then bolt on an extra chapter to handle the family conglomerates that dominate the local landscape.
That captures the process perfectly. They adapt the universal math to fit the local terrain.
Okay, so that leads to the next big question. Who is actually running this translation team and writing these extra chapters? Like, if you were setting up a business in Bangkok tomorrow, whose rulebook are you legally bound to follow?
You would be answering to the FAP.
FAP.
Yeah, which stands for the Federation of Accounting Professions. They are an independent, self-regulatory body in Thailand. Basically, they are the architects responsible for issuing, overseeing, and enforcing these accounting standards.
And the FAP made a structural choice that fundamentally defines the entire Thai accounting landscape. They divided the accounting framework into two distinct tiers based on public interest.
Right.
You have TFRS for PAEs and TFRS for NPAEs, the publicly accountable entities versus the non-publicly accountable entities. But I have to push back on this logic for a second.
Okay, go for it.
If I'm an international investor or even just a local vendor extending credit to a buyer, I want total transparency. Having two different sets of rules sounds like a recipe for shell games or hidden risks. Why not just force every single business to use the absolute gold standard of accounting?
Well, mandating the international gold standard for everyone sounds safer in theory, definitely. But in practice, it would act as a wrecking ball to the local economy.
Really? A wrecking ball?
Oh, absolutely. The full international standards are heavily rules-based and require specialized, highly paid professionals. We are talking about hiring Big Four accounting firms, specialized valuation experts, actuaries, and installing enterprise-level software just to close the books every single month.
So the sheer cost of compliance would wipe out a small business.
Exactly. The administrative burden alone would bankrupt a family-owned restaurant or, a local distributor. The FAP recognized that public accountability requires that intense level of scrutiny, but private enterprise does not.
That makes sense.
So they created the NPAE standards as a simplified, principles-based alternative. It strips out the heavy machinery of international accounting and leaves a functional, cost-effective framework, one that still gives a clear picture of financial health without requiring a whole team of highly paid consultants.
Let's draw a hard line between these two buckets then, because the level of scrutiny a business faces depends entirely on which acronym they fall under. Who exactly are the PAEs, the ones forced to use the complex rules?
The PAEs are the heavy hitters. These are entities with significant public interest. It includes companies publicly listed on the stock exchange, financial institutions, banks, insurance companies, and any business that is currently in the process of issuing public securities.
Okay, so a lot of money and a lot of eyes on them.
Right. And the underlying philosophy there is risk. Because the general public and everyday retail investors are risking their life savings on these companies, the financial reporting must be exhaustive. They have no choice but to use the full TFRS for PAEs.
The public is on the hook, so the accounting has to be completely airtight. On the other side, we have the MPAEs, and these are the private limited companies, the small and medium-sized enterprises, SMEs, and foreign subsidiaries that just don't meet the PAE criteria.
Yeah, so a local tech startup, a privately held manufacturing plant, or maybe a neighborhood retail chain would all fall into this category. They don't have public shareholders relying on their quarterly reports to fund their retirement, so their accountability is fundamentally different.
You know, it makes me think of the difference between commercial aviation and driving a car.
Oh, I like that.
Like, if you are flying a 747 with 300 passengers on board, that's the PAE, you legally need redundant sensors, a highly trained co-pilot, and an exhaustive pre-flight checklist.
Yep.
The public safety is on the line.
Right. And to finish that thought, if you are an NPAE, you are just driving your personal sedan to the grocery store. You still need a functioning dashboard, right? A speedometer, a fuel gauge, a check engine light to ensure the machine is operating safely. But you don't need an aviation mechanic to sign off before you turn the key.
The NPAE standards are basically the car dashboard.
Yes.
But the sources mention a really interesting twist to this system. The NPAE standard is essentially an opt-in exemption. Like the FAP designed the simple dashboard for private companies, but those private companies legally have the option to adopt the full complex PAE standards if they choose to.
Yeah, they are exempt from the crushing complexity by default, but the door is always open if they want to subject themselves to the rigorous international standards.
We will definitely need to circle back to why on earth a small business would volunteer for that kind of punishment,
Oh, there are very good reasons.
I'm sure. But first, let's look at what that punishment actually entails. We know the public jet needs more dials than the private car, but what do those dials actually measure? Let's move away from the high-level theory and look at the tangible differences for the accountants sitting in the office.
Okay, well, what the immediate difference is the sheer volume of physical paperwork.
I can imagine.
For the publicly accountable entities, they are mandated to provide a totally comprehensive set of financial statements. This includes the statement of financial position, the statement of comprehensive income, the statement of changes in equity, the statement of cash flows, and incredibly exhaustive notes that explain the methodology behind all the numbers.
While the private drivers, the MPAEs, get a much lighter load.
Traditionally, yes. Their baseline requirement is a statement of financial position, an income statement, a statement of changes in equity, and notes.
No cash flows.
Well, the FAP recently revised the standards to allow them to present comprehensive income or consolidated statements if they prefer, but the mandatory floor is much lower. So, for instance, a basic NTAE is not strictly forced to prepare a complex cash flow statement.
The paperwork volume is one thing, but the true revelation in these sources is how the actual math changes between the two systems. Our sources highlight 4 massive friction points where the accounting mechanisms just completely diverge. Let's dig into the first one, which is assets and financial instruments.
Sure. Under the full PAE standards, which align with the global IFRS 9 rulebook, companies are forced to rely heavily on fair value measurement and complex impairment models.
Right.
And the most notorious of these is the expected credit loss, or ECL model.
Okay, stop right there.
Yeah.
Expected credit loss sounds like banking jargon.
Yeah.
Explain this to me like I'm running a local tech startup that just extended, say, $1 million of credit to a new client.
Okay, if your startup is a PAE, you cannot just record that $1 million loan and wait to see if the client pays you back.
I can't.
No. The ECL model demands that you immediately start projecting future economic conditions to guess if that client might default down the road. You have to analyze macroeconomic trends, interest rates, and industry health to calculate the probability of them failing to pay.
So I have to be a psychic.
Pretty much. If the model says there's a 5% chance they default next year, you have to write down the value of that asset on your books today. It is highly predictive, forward-looking accounting.
I mean, I see why public markets demand that. Investors need to see the risk priced in before a company actually loses the money, so the stock price reflects reality. But what about the private tech startup using the MPAE rules?
Oh, they bypass the fortune-telling entirely. NPAEs generally use the cost model.
So they just write it down.
Yeah, you record the $1 million loan. If the client actually defaults or shows concrete evidence they are bankrupt today, then you write it off. You rely on historical, realized events rather than complex economic forecasting.
Wow, that alone would save hundreds of hours of modeling.
Oh, absolutely.
Let's look at the second major divergence, which is leases.
Right. For PAEs, they are bound by a standard known as TFRS 16. The core mechanism here is that almost all leases must be capitalized and placed directly onto the balance sheet as a right-of-use asset.
Okay, let me make sure I understand the mechanics of this one. Let's say I run a national coffee chain. I don't own the buildings, I just sign 10-year rental agreements for the cafes. Under the old way of doing things, I just pay my monthly rent, record it as an expense on my income statement, and move on.
That is exactly how it used to work, and it led to major transparency issues.
How so?
Well, a company could look completely debt-free on paper, but they were secretly locked into billions of dollars in unbreakable long-term lease commitments. If revenues dropped, those hidden lease obligations would bankrupt them, and public investors would be totally blindsided.
Yikes. So how does TFRS 16 fix that?
It forces the PAE coffee chain to calculate the total value of that 10-year lease and slap it onto their balance sheet as a massive asset, alongside a massive corresponding debt liability. It radically alters their debt-to-equity ratios.
That is a colossal shift in how a business looks on paper. But if I'm a private coffee shop owner using the NPAE standard,
You stick to the old way. You treat it as a simple operating lease. You pay the rent, you expense the rent, and your balance sheet remains completely untouched by those future obligations.
okay, so moving from the buildings to the people working inside them, The sources point out a third major difference regarding employee benefits, specifically long-term promises like pensions.
Yeah, this is a big one. When a publicly accountable entity promises a pension to an employee upon retirement, they are required to calculate that future burden using actuarial valuations and specific discount rates.
You lost me at actuarial valuations. I understand that a dollar tomorrow is worth less than a dollar today, but how does an actuary fit into an accounting department?
Well, the PAE has to hire specialized statisticians, actuaries, to study their workforce. These experts use mortality tables to estimate how long employees will live after retirement.
Oh, wow.
Yeah. They project future salary increases, they factor in inflation, and then they apply a discount rate to figure out exactly how much cash the company needs to set aside today to fund a payout 30 years from now. It is incredibly dense mathematical modeling.
And the private NPAE company, do they get to skip the mortality tables?
They do. NPAEs are permitted to use reasonable estimation methods, provided those methods are deemed appropriate and signed off by their auditor. It is a pragmatic, straightforward calculation rather than a strictly actuarial one.
Okay, the final major accounting clash, highlighted in the sources, revolves around consolidation.
Right. If a PAE acts as a parent company with control over multiple subsidiaries, they are legally required to consolidate all of those disparate financials into one massive, unified view of the entire corporate group.
Which means they have to go in and manually eliminate every instance where they sold something to themselves, right?
Exactly.
Like, if the parent company's manufacturing arm sells parts to the parent company's retail arm, they have to scrub that intercompany revenue so they don't artificially inflate their global sales numbers.
And it is an agonizingly complex process of aligning accounting policies across multiple entities. For NPAEs, however, consolidation is generally not required. The parent company can simply report its own standalone numbers, which drastically reduces the administrative burden at the end of the fiscal year.
So we have forward-looking credit models versus simple historical costs. We have massive lease liabilities on the balance sheet versus just paying monthly rent. We have mortality tables versus reasonable estimates. And exhausting corporate consolidations versus standalone reporting.
Pretty much.
It is abundantly clear why the NPAE standard is a lifeline for small businesses.
It really is. It saves them an immense amount of capital that can be reinvested into actual business growth rather than compliance overhead.
Which brings me back to that strategic question we tabled earlier.
Right.
If you are a private company and you have the legal right to use this pragmatic, cost-effective method, why would you ever voluntarily opt into the massive PAE paperwork? Why volunteer for the commercial jet dashboard?
Because a company's current regulatory status doesn't always reflect its strategic ambition.
Okay, what do you mean by that?
Consider a successful privately held tech company in Bangkok. If their long-term goal is to attract major foreign investment, perhaps a global private equity firm wants to buy a majority stake, those international investors are going to demand to see the financial history in a language they can model and stress test.
Right.
They need the predictive, granular data of full IFRS to assess their risk.
So the private equity firm won't accept the simplified dashboard because it hides the long-term lease liabilities and doesn't predict credit losses.
Exactly. Furthermore, if that private company is planning an initial public offering, an IPO, they absolutely must step up and use the full TFRS for PAEs. You cannot list on the public stock exchange using NPAE financial.
Oh, that makes sense.
So ambitious companies will voluntarily adopt the complex standards 3 to 5 years before they actually plan to go public. They absorb the painful cost of upgrading their software and training their staff early, so they have years of pristine PAE-compliant historical data ready for the regulators.
You essentially have to train with the heavyweights for years before they actually let you step into the professional ring.
That's a great way to put it. It is a deliberate strategic burden they take on willingly to unlock access to global capital markets.
This has been a phenomenal journey through the engine room of Thai finance. We started by looking at how the universal math of the global IFRS standards serves as the foundation. We uncovered the intense legal stakes of translation, where a single misunderstood word can alter corporate liability, forcing a mandatory one-year delay.
Yes.
And we explored how the Federation of Accounting Professions acts as the gatekeeper, ultimately bifurcating the economy into two distinct realities based entirely on public risk.
And, the transition from the simplified NTAE framework to the rigorous PAE standards, it isn't just an administrative hurdle. It is a fundamental shift in how a company views time and risk. Public accounting forces you to look forward and predict the future, while private accounting allows you to look backward and record what actually happened.
Before we wrap up, I want to leave you with a final thought to mull over, building on that concept of time. Think back to the one-year mandatory translation delay we discussed at the very beginning. We live in a hyper-connected, real-time global economy where multinational companies operate seamlessly across borders.
It's true. And imagine the hidden friction this creates. If a massive global corporation headquartered in London is operating on the absolute latest real-time global accounting standards, but their local subsidiary in Bangkok is legally operating on a regulatory clock that is ticking exactly 1 year behind.
What kind of administrative nightmare arises when a local subsidiary is legally out of sync with its parent company's headquarters? Like, how do you smoothly consolidate a global balance sheet when one of your biggest factories is legally required to live in the financial past? Because at the end of the day, the numbers might be universal, but the rules are intensely local. Thank you so much for taking this deep dive with us today. Keep questioning the systems behind the numbers and keep seeking out those aha moments in your own research.